What is stop loss in Forex trading? In Forex trading, stop loss orders are crucial for effective risk management. They help traders limit potential losses by setting predefined exit points. This way, if the market moves unfavorably, the stop loss order automatically closes the trade, minimizing damage to the trader's account. Using stop loss orders can be a game changer for traders. They help control risk, making sure you don't lose too much. These orders are a key part of trading, letting you set a limit for when to leave a trade. Successful traders know the value of cutting losses and keeping gains safe. Stop loss orders are like a safety net, ensuring that bad trades don't hurt too much. You can change these orders easily, but some trades might end early if prices move quickly. In the growing field of Forex trading, having good Forex risk management strategies is key. Stop loss in Forex trading is very important. It helps to cut how much money investors might lose. This way, traders are safer and their money is better protected. Forex traders can decide on a stop at a set price. This price won't change until the trade hits the stop or takes profit. For example, a trader could set a stop at 50 pips and a take profit at 100 pips, a 1:2 risk-to-reward ratio. They often use tools like the average true range to pick these points. A trailing stop is another good way to protect gains. As a trade moves in their favor, the stop moves with it. This way, they lock in profits gradually. By actively managing the stop, like moving it manually or by a fixed amount, traders stay in control. Good Forex risk management means limiting losses to 2% of the total capital. To set a stop, work out the most you're willing to lose, for example 2%, and place the stop there. This way, if things go wrong, your losses are contained while you try to make gains. Stop loss in Forex trading doesn't just protect from big losses. It can help secure profits too. But watch out for things like slippage or sudden market changes. They can make your stop loss sell at the wrong price. Stop loss orders are important for Forex traders. They help guard against bad market shifts. It's key to know the various stop loss types to pick the right one for your trading style and risk plan. A fixed stop loss is straightforward. It's set at a certain distance from a trade's entry point. If the market reaches this level, the stop loss closes the position. It stops further losses or locks in a gain. Keep in mind, it doesn't change with market movements. A trailing stop loss is more flexible than the fixed type. It moves with the market's price if it's in the trader's favor. For instance, a 20-pip trailing stop will adjust as the market price goes up. This helps secure gains without a trader needing to constantly check and adjust their stop loss. The guaranteed stop loss is special. It makes sure the stop loss is executed at the exact set price, no matter the market's fast movements or slippage. It's the most secure, but costs more. This can be very helpful in fast markets where slippage is a big concern. Knowing about these stop loss order types helps traders manage their trades better. You might focus on fixed levels, on-the-go changes, or execution guarantees. Each type has its benefits that fit different trading strategies. Stop loss orders are essential in Forex trading to help minimize losses. First, traders pick a stop price. This is the point where the stop loss order goes into action. They also need to decide if it will be a market order or a limit order when it activates. Market stop orders are popular because they ensure selling once the stop price is reached. But there's a chance of slippage due to market changes. If you pick stop loss limit orders, you're less likely to sell at a bad price. However, it's not guaranteed your order will fill. When setting up a stop loss order, analyzing the market and your specific trade is key. Let's go over some important steps and things to think about. Choose a stop price. Place the stop loss order where you think your trade idea will fail. This limits risk while aiming to make a profit. Look at market volatility. The average true range, ATR, can help you set stop loss orders. Usually, setting your stops at 1x to 2x ATR can protect you from big market swings. Use indicators. For example, Bollinger Bands can guide you to a good stop loss range. Putting your stops just outside those bands can help prevent small price changes from stopping you out too early. Think about time limits. Time-based stops are good for day traders who don't want to hold positions overnight. A time-based stop can be when it's just not working out with a trade. Manage risk. Your stop-loss level should keep your losses at an acceptable level. A rule of thumb is risking no more than 2% of your account on one trade. Control emotions. By using stop-loss orders, emotions are less likely to drive your trading decisions. Stop-loss orders help Forex traders in many ways, making their strategies better. They are key for risk mitigation. With stop-loss orders, traders can pick a point to stop losses from growing too big. Say you buy a crude oil futures contract at $1,000. If you use a stop-loss at $950, you keep from losing more than 5%. These orders also help with emotional control in trading. They automatically sell when the price hits a certain point. This takes away the need to always watch the market. It stops traders from making quick, bad choices because the market is moving. Traders have many choices in stop-loss orders to match different market conditions. They can use a trailing stop-loss, which moves with the market. Or they can pick a guaranteed stop-loss that sells at exactly the chosen stop price. This flexibility and safety net helps trade smarter and protects against big losses. Using stop-loss orders together with tools like average true range, ATR, makes trade choices smarter. ATR takes real market data to help decide the best stop-loss distances. This approach offers many options, such as moving stops based on market changes. This makes trading more informed and controlled. At the end, stop-loss orders are a vital part of a trader's game plan. They bring in automation and keep emotions in check. With these, traders can handle the ups and downs of the Forex market better. They gain more confidence and lower their risks. A big mistake many traders fall into is putting their stops too near the starting point. This can make them exit trades early, missing out on chances to win big. Setting stops too close doesn't leave enough space for prices to move before or backwards a bit from the intended way. Market volatility affects stop-loss orders a lot. The Forex market can be very volatile, which may trigger stops at prices much worse than expected because of major price shifts or market gaps. For example, the GBP USD varying by 110 to 140 pips in 2006 shows how much the market can move. Setting stops too far from the entry point can make it harder for a trade to be profitable. This adjusts the risk-reward balance in a bad way. To tackle this, traders can use trailing stop-loss orders in times of market volatility. This can help lock in earnings and cut down losses more effectively, softening the blow of sudden market shifts. Don't put stops right at support or resistance levels because prices often sway at these points. Using tools like RSI to decide when to exit can be smarter. Knowing how you like to trade is key to placing stop losses effectively and avoiding common traps. In times of a market trend, traders may use trailing stop-loss orders, allowing them to keep profits if the price goes their way. This strategy keeps the stop-loss at a fixed distance, but moves with the price. Making sure the potential profit is more than the stop-loss. Size is key, as 87% of traders believe. During a market range, traders put stop-loss orders near key support and resistance levels found using tools like Fibonacci. This helps set stop-loss levels that fit the market's up and down movements. Also, having several stops can lessen the risk of sudden market changes and offers more trade control. Markets with a lot of ups and downs need a different approach. To deal with high volatility different from the average true range, ATR. It sets stop losses based on how much prices change. This way, stop losses aren't too tight or too loose. About 70% of traders use this technique. Lastly, using a mix of stop limit and traditional stop loss can lower losses during big market swings. Stop loss orders are a must-have in Forex. They keep traders from making choices based on feelings. A whopping 98% of traders agree on their importance. All professional traders recommend using stop-loss orders. They improve trade safety and promote disciplined trading. Platforms such as Light Finance, MT4, MT5, and Quick make it easy to set stop-loss orders. They allow traders to set stops based on currency pairs, pips, or chosen closing prices. Lastly, to be successful in Forex trading, it's crucial to align stop-loss strategies with your goals and the market. This boosts trading efficiency and protects investments. By using strategies suited to different market conditions, traders can do better in the Forex market and make more consistent profits.